Welcome to episode 6, week 12 of my weekly portfolio update here on The Last Investor. My last portfolio update video was 5 weeks ago, so I'm in a doghouse for not doing my weekly videos, I'm afraid. But today I plan to make it up to you with a jam-packed episode. For those of you who are new to the channel, my name is Dan, and I'm at the very start of my journey to financial freedom. My goal is to use the dividend growth investment strategy to grow my portfolio long term. I invest £200 every week into my free trade ISA account and update you on my experiences through the highs and the lows. I follow 4 rules in identifying a core group of stocks that I invest in. I then allocate my weekly funds to the ones that drop in value. The lower they drop, the more I allocate my weekly funds to them. Also, by investing weekly, I'm able to follow the market and hopefully I'll make the gains when they go up. But most importantly, those dividends will be instrumental in the growth of my portfolio overall. So today the topics I want to cover is to give you a portfolio update and then give you some update about the dividends that I've received. Also, I'll give you a little bit of a talk on the investing strategy that I'll be using in the current economic climate. And then I also want to touch on the Tesla madness and 5 reasons why I'm on board with it. And also the Bitcoin madness and 3 reasons why I think Bitcoin is something that's going to be a future value. So without further ado, let's get into it. Just to give you an overview of my portfolio's performance for the week, but I guess I should call it the month, as it's been 6 weeks since my last update, and that's something I really need to keep to the curb. When I did my last video on the 4th of September, the overall value of my portfolio was £1,860.17. Having invested 1,900, that meant that my portfolio was down about 2.1% at that time. But as you can see now, my portfolio value in total is £3,389.81, and I've actually only invested £3,300, which means that the £89.81 that you can see is pure profit for me. So my portfolio is in effect up 2.72%. Now, just to touch on some of the dividends that I've received dividends from a renewable infrastructure group, TRIG. At the time that I received a dividend from TRIG, I had 334 shares, and the dividend was paid out to me on the 30th of September, and I received a grand total of £5.54. I can't quibble about that. Any money is good money for me. I currently now hold 440 shares in TRIG, so that's a good addition for me. Then the next dividend payment that I received was from BHP. As you can see, I own literally just 2 shares in BHP at a current value of £33.11. But I in fact received on the 30th of September £1.26 in dividends from them, so quite happy with that. I know that this is a share that I will be selling in due course once it goes into profit, but that doesn't look very likely as we seem to be in an economic downturn, and the mining sector seems to have been the hardest hit by the current economic downturn. So that may well be the case, it may well still be at this value for a long period to come, and I think it will take a while before we see it heading back into the positive or into the green. So the next dividend that I received was on my share in Monday. That dividend payment was made on the 23rd of September, and at the time I had about 4 shares which paid out 98p. Now I currently own about 20 shares in Monday, so again I wouldn't complain about that, and that's really good. Then the next one I received was from Rio, and that was on the 19th of September. And Rio paid out £19.04 for 11 shares. And now I currently hold 26 shares in Rio. And of course, Rio is my largest holding. So in total, the dividend payments I received, all of which were in September, was for £26.82. And hopefully that will be a lot larger for my next dividend payments round. So that's it for my dividend payments, and I'm really quite happy about that. And hopefully as I buy more shares in these companies, then my dividend payments will be larger. So that's something to look forward to. Then really on to talking about my strategy for investing. Given the current economic climate, I think we can all agree that the news is currently littered with talks of a slowdown in the economy, talks of PMIs going down, and yeah, so it's looking very gloomy. The outlooks are looking really gloomy. Recent earnings reports are coming out, especially in October, and these appear to show a drop in terms of earnings for a number of tech companies, and that only seems to be a pattern that's going to grow going forward. So my plan and my strategy is to only buy shares when the overall my stock is in the red. So for example, I will be buying more shares in Rio Tinto. As you can see, it's the only stock that I currently have that is in the red. So I need to get my average share price down, because my average share price, as you can see on here, is currently £43 per share, and the current price is trading at £41.10. So the more I keep buying at the current share price, which then it brings the overall average of my shares down closer to the current trading price. So that's my aim. I will not be purchasing any of the other shares which are in the green, as I feel that as we head closer and closer into a downturn, then it is more and more likely these other companies that I own stocks in may well fall in value, and it will make no sense me buying at this higher price when I could potentially buy at a lower price when they fall in value. So that is my reasoning behind that. As you can see, two of my most current holdings are up over 10%. Bellway is at 11.69% and Aviva is at 16.27%. I want to also talk a little bit about the types of stocks that are out there. Obviously, there are growth stocks and there are cyclicals. And obviously, cyclicals are stocks that should be kept an eye on more when there is an economic downturn, because they seem to get more affected when there is a slowdown in the economy. And my ideology behind this is to buy cyclicals, buy more of cyclicals during a downturn, because when there is an upturn in the market, then the prices tend to go up quite dramatically. And when you look at the max chart for Rio, you can see a pattern of a downturn and followed by an upturn, and then downturn and an upturn, almost in a ladder format. And as you can see at the moment, we're currently in that downturn towards the very end there. And if you look at the 1 year's chart, you could see very clearly how the price has gone up to about 30%, and it's now gone all the way back down to about 10%, which is again part of that cyclical pattern. And so the plan is to buy as much as I can at this stage, because once that upturn comes round, I wouldn't be purchasing any of it, and I'll most likely be investing in my other stocks. So that's the ideology behind it. Defensives, on the other hand, do well during a downturn. Defensives are sort of utilities, healthcare, telecoms, but it isn't always an exact science in relation to that. I would probably classify Monday as a defensive. The price tends to stay relatively stable over time, but it doesn't look like that in this current pattern. But nonetheless, that's something to keep an eye on overall. Then people's instinct when it comes to stocks falling in value is to always look to actually sell. But in fact, it's a really, really bad idea. I know it sounds very obvious and it's very straightforward, but people's instincts is a really, really strong thing. People tend to think, well, if it's going down in value, there must be something wrong with it. And it's understanding the difference between the types of stocks that you're holding, and understanding that some of them might be cyclical, and that might be an explanation as to why it's falling down in price, as opposed to there being something wrong fundamentally with the company itself. Of course, if something were to be wrong fundamentally with the company, then it will most certainly drop in value, and that drop in value should not be confused at any stage with a cyclical downturn in a particular industry or a sector. Certainly it's something to keep an eye out for, but that's something that people can easily fail to identify, and instinctively your mind tells you if it's going down in price, it must be because the value is something wrong fundamentally with the company. And Benjamin Graham, who is Warren Buffett's mentor, as I said, Warren Buffett worked under Benjamin Graham for a number of years before going out on his own. And Benjamin Graham said something which is quite poignant. He said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Basically, what that means is that when prices go up, a lot of people are pumping money into a particular stock. Oh wow, it looks great and it's fantastic, and pumping money into it. So it's a voting machine in that sense, almost like a popularity contest. But in the long run, when things really take a turn for the worse, or when you have a correction in the market and the price really comes back down to its true value, it becomes a weighing machine, and you will then receive the true value of what you've actually purchased. And if you've purchased high, and the true value comes along, maybe in a downturn, then you will see that in fact it's not really worth as much as you actually paid for it. And that's why it's very important to always look at fundamentals and make sure that you're purchasing at the right price. So I'm always very skeptical of price hikes. It means that it's too expensive, and when the price drops, then it means that it's a signal for me to buy. Always stick to fundamentals. And when I say fundamentals, I mean that the company has a good balance sheet, has a steady growth both in revenue, income and dividends, and it also has a competitive advantage because it's something that other companies or other competitors can't really get into and usurp the competitive advantage of that company. So it's important to invest in those sorts of businesses. And most importantly, it's trading at an undervalue. And when I mean undervalue, I would mean that it has a price to earnings ratio of around 15%. Price to earnings ratio of around 15 or lower, and a price to book ratio of about 1.5. Now, price to earnings basically means that the price that you pay for it and the company's earnings are no greater than 15. So the earnings must not be any more than 15 times the price. And if it is, then it's too expensive. If it's 30 times the price, then it's 30 times the earnings. If the price is 30 times the earnings, then it's too expensive. If the price is 15 times the earnings, then that's good. And anything lower than that is fantastic. And price to book is the same. If the book value of the company is 1.5 times the price, then again, that's good. But if it's more than 1.5 times the price, then it may not be necessarily be at an undervalue. It may be overvalued. The app that I use in working out whether a particular stock is expensive or cheap is an app called Guru Focus, and I would recommend you to download that and have a look and play around with it, because it's a good start to work out whether or not a stock is at an undervalue. And I'm going to give you an example here. I'm going to use Rio Tinto as an example. So I'm going to go to Guru Focus, and on here you can see how you always do. Simply you type in the name of the company you want to research. It comes up Rio Tinto London Stock Exchange, because that's the exchange that we use over here in London. And so you can see there that the price is currently trading at £41.18. That's what Rio Tinto is trading for. And then if you look down here, the price to earnings, and the TTM stands for trailing 12 months. So, of course, earnings come out once every year. So you're looking at the last earnings record for Rio Tinto. So based on that earning for the last year, the price, this current price of £41 is 6 times the earnings. So you could actually work out the earnings per share by taking 6.61 and dividing £41 by 6.61, then that will give you how much Rio Tinto earned last year per share. So that's how you work out the earnings. So you can see that the price to earn is 6.61, which is really good. As we said, 15 is the benchmark, and anything higher than that is tends to be considered as expensive. Of course, it's not an exact science, and certain types of stocks, especially growth stocks, could be trading at 20%. Could be trading at 20 PE or even 25p, and could still be a relatively decent and valuable stock, especially when you consider other factors such as the likelihood of growth of the company. And I'll come and talk about that when I talk about Tesla. But anyway, just for now, that gives you an indication. The other two figures I'll look at here. So the price to book ratio is right here, and that's 1.69. Again, it's not bad. It's slightly above what I would normally recommend, but in combination between the price to earnings and price to book, if you multiply those two, as in 15 times 1.5, that should normally give you 22.5. So if a combination of the price to earnings and price to book is below 22.5, then again that shows that the value it's undervalued. Another thing I look at is the Graham number, and the Graham number basically is a calculation that Benjamin Graham, again, who I talked about earlier on, uses in valuing stocks. And he was more interested in value stocks, so stocks which are dirt cheap and at a total undervalue. His philosophy was that if a company was trading at its book value, then it's a bargain. Anything above that is going to be pure profit as far as he was concerned, and that's the way he looked at stocks and when he purchased stocks. And so he always looked for stocks which really were trading at literally at value, at book value or lower. So here on that basis, this would work out as 55. This will value the company and Rio Tinto. The Graham number will value Rio Tinto at £55 per share. And so, as you can see, currently a share price of £41 is considered undervalued when looking at the Graham number. Then the other thing to look at is the discounted cash flow. Now, this is the cash flow that the company is expected to generate over a number of years, say, for example, 10 years. or 20 years, as been shown in this particular discounted cash flow model. And this model would suggest that the fair value for Rio Tinto is £66. So again, according to the discounted cash flow model, this is significantly undervalued. In fact, there's a margin of safety of 38%. And when you then add the tangible book value to that, which is this figure here, that basically pushes the margin of safety up to about 53%, and the actual fair value is now considered as £88.89. So it's literally trading almost double, or in fact double its actual fair value. So that is why I'm personally have been investing heavily in Rio Tinto, and it is my largest stock holding in my current portfolio, and also pays a very great dividend, as can be seen from the dividend summary I gave earlier on. So there we are. That's my strategy for investing in the current climate. Now on to Tesla. I just want to talk about Tesla a bit here. So you may not know, but I in fact do buy other stocks other than dividend stocks, which really is my bread and butter, and that's why I use for investing on free trade. I only invest in dividend stocks and free trade, but I actually also invest separately in growth stocks. I try and identify some growth stocks which I think could be valuable in the future, and today I want to talk about Tesla. So Tesla over on Friday effectively posted a third quarter profit for 2019, and the sentiment around this has now driven the stock price up from about $240 to $328, which is a huge spike in price. I'm going to show you a chart just to give you an indication of how the prices have spiked. Literally, if I give you the hourly chart, you could see how it had literally spiked from literally around 220, 230 all the way up to 328 in the space of literally from 250 all the way up to 328 in the space of a day. So that is really dramatic a rise in price. I actually purchased the current stocks that I hold in Tesla in May 2019, and at that time was trading at $192.55 per share. So for me, my own personal experience, I've seen a 70.26% increase in my share in profit, basically from those shares, from those shares that I purchased. So the first one, which I invested £100, purchased £100, is returned me £69 profit, and the other one, £50, returned £35 profit. So in total, returned £105 profit. If only I'd actually invested more than just £150, I think I'll be laughing right now. If, for example, I invested £1,500 or £15,000, I could be sitting on a very healthy profit right now. But obviously, I don't have that amount of money to invest, hence why I've only invested £100 and £150. But in time, I will be investing more in due course, hopefully. But obviously, the obvious question is, why did I buy Tesla stocks in the first place? So Peter Lynch says that we as consumers have a better understanding of the products we are exposed to daily, and we know more about it than the regular paid investor, and we can use that knowledge to advantage. And that is exactly what I've done here. I've basically used my knowledge to invest in this particular stock. My personal knowledge and experience of Tesla has meant that I have a lot of belief in it, and I'll give you 5 reasons why. So the first is that I have driven a Tesla, and shocker alert, I actually own a Tesla. Yes, please. I can see all the comments coming about. Is that really a wise investment? Yes, I know. A midlife crisis, but there we are. But nevertheless, I think it's an excellent product. It's by far the best car I've ever driven. It has a huge touch screen, which I call the super iPad, and it's brilliant. It receives live over-the-air updates to its software. It has Spotify, which comes free with the car. It's got 3G internet connection, which means you can surf the internet at any time, even whilst the car's been driven. I kid you, no, not really. But yes, you've got 3G internet connection, but you can use that to stream Spotify. It's got games on there, including Beach Buggy, and the Beach Buggy game. You can actually drive the car with. You can control the game with the steering wheel. So driving it as if you're actually driving a car and using the steering wheel of a car to navigate your Beach Buggy on the game. That's brilliant. It also has YouTube now. The most recent update, it basically is installed YouTube and Netflix, and it allows that to be actually. Basically screen allows the screen to play that, and that's brilliant. No other car in the world has got these features in them. Not even the most expensive luxury car that you can think of. It is by far the best car that I can think of, and I love it absolutely. And on top of that, it's electric. It doesn't get any better than that. So, and then the second reason why I love the Tesla brand is the pace at which Tesla has been growing. So its sales is completely mind-boggling. In 2016, they sold about 75,000 cars. So 75,000 cars were delivered in 2016. In 2017, 103 Teslas were delivered. That's literally over 40% increase in car deliveries. And in 2018, 244,000 cars were delivered. That's well over double the previous year. And then so far, third quarter of 2019, 255,000 cars have been delivered, and it is set to smash records again by year end. Then what you might not be aware of is that Tesla has recently built a gigafactory in Shanghai, where it's going to be producing and selling cars directly into the Chinese market. And again, that is going to exponentially increase the number of cars delivered. If you think 255,000 is crazy, then next year, hold on to your hats, because it's going to blow all records out of the water again. So that's my second reason why I love this car. It's a hugely growing company, and it is increasing its production at a fast pace. Revenue is also incredible. The revenue story is also incredible. In 2016, financial year end, had a revenue of £7 billion. And then in 2017, financial year end, had a revenue of £11 billion, which was a 67% increase on the previous year. Then in 2018, it had a revenue of £21 billion. That's an 82% increase on the previous year. And then so far, halfway through the year, £24 billion revenue. And it's looking like it's going to be smashing records again for this year, 2019. And just to give some context around it, Tesla currently has a market cap of £58 billion, and its revenue is already halfway through the year, £24 billion. If it gets anywhere close to £40 billion for the year end, then it will be smashing significant records. And also, that puts its annual revenue so close to its overall market cap, and that is incredible. Now, to give some context to this, Rio Tinto, which we looked at earlier on, has a market cap of £69 billion, and its revenue the previous year was £41 billion. And look at how undervalued Rio Tinto was. And so that gives you some real context as to how fast this company has grown and how much it's actually generated in revenue. It's really, really incredible. And then the fourth reason why I love this company, is its autonomous taxi network. This has not been priced into its current company valuation, and I've experienced the Tesla Autopilot firsthand, and it really is a surreal experience. I recently drove from London to Nottingham in my car, and on the M1, I literally had the car on autopilot all the way from the beginning of the M1 all the way to Nottingham. And I tell you, the car was, it basically, it drove all the way, it stayed in a lane, I didn't have any reason to intervene. It was basically picking up space and was maintaining space at 70 miles per hour. And when we hit a traffic, it came all the way down and maintained pace with the car in front. If I had to change lanes, all I had to do was click on the indicator and it changed lanes by itself. And it was just an incredible experience. I literally didn't have to do anything other than periodically touching the steering wheel to let the car know that I was still awake, basically. So that's just incredible. I literally can see full autonomy in a Tesla in about 5 to 10 years' time in the UK, and I certainly can see it happening a lot sooner in the US. It will be a huge challenge for any other company trying to get into the autonomous vehicle sector. I see it very difficult for them challenging Tesla. I think Tesla is going to be the number one in that area. The only other company I can think of that currently does autonomous vehicles is Waymo. Waymo used to be owned. Waymo used to be owned by Google, but of course they've split up. And Alphabet, it's now under the Alphabet umbrella, which obviously Google is under the Alphabet umbrella as well. So it's a standalone company on its own now, under the Alphabet umbrella. Waymo's model of autonomous driving is very, very different to that of Tesla. Waymo basically is basically concentrating on a specific area in America, and it basically has developed a map of that area, and it's literally knows that area and can drive around, do turns in the road and everything, all on its own. So it really has reached level 4, level 5 autonomy, whereas Teslas haven't reached level 4, level 5 autonomy yet. But of course, the limitation for Waymo is that it's only at level 5 or level 4 autonomy for that specific area, and it has to gradually build out into other areas, and that will take a huge amount of time to complete. Whereas Tesla, on the other hand, its autonomous driving is already worldwide, and it's collecting data from every single driver that drives a Tesla, whether even if it's privately owned Teslas. Every data that comes out from every car on the road, every Tesla on the road, gets fed back into Tesla, and they use it to train their AI, which then basically gets improved. And when it improves, they basically release the over-the-air updates, and then we get the improvements straight away. And really, it's a very, very improved, really, really surreal experience, and very impressive indeed. So that's why I believe in it. And then finally, the fifth reason why I have a huge amount of faith and belief in Tesla is because of its expenditure and profitability, future profitability. Tesla has invested aggressively in a number of things. It's invested aggressively into the battery technology. It's recently purchased Maxwell Technologies, and basically that's a company that has created a dry cell battery technology. And the whole idea behind dry cell battery technology is that it helps to avoid or helps to resolve the issue around battery degradation. So batteries should last a lot longer. and it also has another technology in the ultra capacitors, which pump out energy very quickly and take in energy very quickly. So that really helps with acceleration, and that will then act as a buffer to the main battery as well. So all in all, once that technology has been put together by Tesla, it's going to be incredible. We're literally going to be seeing a dramatic change in the world of batteries and car and electric cars in the future. It's only going to get better, and this company is only going to become more profitable. Of course, it's invested heavily in AI technology as well. It's just recently purchased an AI company to ramp up the development of its AI technology. It's also built a huge supercharging network, which no other auto manufacturer is ever going to be able to compete with. And really, once it hits full efficiency, this company is going to be really profitable. That is the truth, and that's why I'm really, really bullish on Tesla. So I will be investing in Tesla more in the future, because I think the company has got the right ethics. It has a lot of debt, which is one of the things I worry about. But given everything that I know about this company so far, this is one of those very exceptional circumstances where I literally will just put aside my concerns about its balance sheet and just have a huge amount of faith in the way the company is being run, because I can see firsthand the direction of the company. I know that the company isn't going to be changing hands anytime soon. Elon Musk doesn't have any plans for selling that company, and I know that company is in very good hands and is run very well. So now on to Bitcoin. Bitcoin is a very interesting one. When I did my last video on the 7th of September, Bitcoin was trading at 10,438. And then around 20th of September, just after I entered the trade at around 10,150, Bitcoin tanked. Then by the 24th of September, it was trading at around 8,400. So I decided to invest another $150 into Bitcoin at that stage. But this also meant that my initial $150 investment was down 15%. Then around the 6th of October, Bitcoin fell even further and was then trading around 7,903. So I was now down over 20% on my first $150 and about 8% down on the second $150. So what did I do? You guessed it, I bought more Bitcoin. I bought a third $150 worth of Bitcoin. And then something dramatic happened yesterday. I woke up this morning and I had looked at my Bitcoin app and I was rather confused as to what I was seeing. Bitcoin has shot up from literally $7,400 to $10,329. My first $150 closed out by itself automatically with a profit of $2.81 when it was initially running at an almost $30 loss. And that was because I set the stop loss really low, just to show you where it was. The stop loss, the take profit I set was 0.4. So if it'd gone down below that, it was going to close out. So hence why it closed out at that level with a profit of $2.81. Then my second, I willfully closed that out myself. And as you can see, I closed it down when it was at a profit of $9,660, making a profit of $26.57. And it was a 15% profit that I made on that one. The third one, as you can see, is currently running at a profit of 16%, as the price is now settled back down to around $9,150, So in total, my crypto portfolio is worth about 595 US dollars, and the total Bitcoin count I now have is 0.065%, 0.065 Bitcoin. So I've slightly cheated and accelerated my race to 1 Bitcoin. I treat it as a form of investment now, and there are 3 reasons why I believe in Bitcoin. So the first reason why I believe in Bitcoin is that it is a unique creation. There is nothing like it, and it is unlikely that anything like it will ever be created again to match its uniqueness and momentum. So that's one reason. It's not really owned by anyone. Its creator, Satoshi, has gone underground and no one really knows his identity. So Bitcoin basically runs by itself. It is not regulated by any central authority. It runs basically on a decentralized system, which means that its users basically regulate it, and they regulate it by through a process called Bitcoin mining. So this mining process allows miners to cross-check transactions that occur on the Bitcoin, on the actual Bitcoin blockchain itself. And when the mining process takes place, each block is basically checked and cross-checked to make sure that the transactions are accurate and done properly, and that there hasn't been any discrepancies. And each time a block is checked, the person who carries out that block check basically gets put into a lottery pot with any other Bitcoin miners who mined that particular block, and whoever is successful in being selected receives Bitcoin as a reward for that mining process. And so what happens is that these miners, they mine several blocks at a time, and basically with the aim of actually earning Bitcoin. So that carries out a number of functions. This process allows miners to cross-check transactions to ensure that they are valid, thereby making it difficult for counterfeiting to take place. People are also incentivized to regulate it by earning Bitcoins for the regulation process, i.e. the mining process. And then the mining process is also the process by which new Bitcoin is created, because every time a mine is completed, a Bitcoin is then Bitcoin is generated and given to one of the miners. So the mining rate started off at 50 Bitcoins every 10 minutes, so or 50 Bitcoin per block. And what happens is that after 210,000 blocks are completed, which usually takes about 4 years, then the number of Bitcoin reward per block gets halved. So the first halving took place in 2012, and that halved it from 50 Bitcoins to 25 Bitcoins per block, which is basically 25 Bitcoins every time a reward is granted for each block. Then in 2016, there was another halving, and that halved it from 25 Bitcoins to 12.5 Bitcoins per block, which basically is now the current reward, because we haven't hit the 4-year period for the next halving. So that means that the next halving is going to take place next year in 2020. So because of this unique process, Bitcoin is limited in its supply, and this will naturally cause its value to appreciate, similar to gold. And that's where gold derives its value from, because there is only a limited amount of gold because of the mining process and how difficult it is to actually mine gold. And so Bitcoin effectively has become this digital gold, effectively, and especially with the way it's been created. No one can change this rule. The rule is set and is fixed. We don't know where Satoshi is, and the creator of Bitcoin, that is. He's effectively left this contraption that he's created, and basically everyone who's involved in Bitcoin mining are the ones that basically regulate Bitcoin through the mining process, and they get rewarded that way. And obviously, as time goes by and with the halvings taking place, there will be less and less Bitcoins available, which naturally would increase the whole value of it. And that's why I see this as a very, very unique product, which is only going to appreciate in value as time goes by. And there really isn't anything like it. None of the other cryptocurrencies are created or run in a similar way to Bitcoin. To Bitcoin. And it really can easily be the currency of the future. And many institutions and businesses are already accepting Bitcoin as a form of currency. So it can easily be something that becomes widely adopted worldwide in the future. Other businesses have also notably tried to create similar cryptocurrencies, but none of them are going to have the advantage that Bitcoin has, because now that Bitcoin has come along, the major countries such as America have now become wise to this and are very cautious of and very wary of new institutions getting involved in cryptocurrency. So Facebook, for example, with its attempt at launching its own cryptocurrency, had to face huge criticisms earlier this week when he was present in front of Congress. And one of the issues that were raised was about how it needs to be regulated. It needs to cut out the risk of anonymous underground purchases, anonymous purchases, because it's considered that fuels the criminal world, underworld. So the Congress are effectively trying to lobby, if lobby is the right word. I'm not sure what else they could do to Mr. Zuckerberg, other than effectively try to put pressure on him to create Bitcoin in a way, to create Libra, his own cryptocurrency, in a way that makes it more transparent. So it's you're never ever going to get another cryptocurrency, or unlikely to get another cryptocurrency that has all of the benefits, all of the attributes that Bitcoin has. And that's what makes Bitcoin extremely lucrative. So that is why that is why I have a lot of belief in Bitcoin as well. Not just because it's some sort of cryptocurrency phase or fad, but really because there is some logic behind it, and there is some huge advantage and benefit that it does give as well, and it will be a valuable product going forward. So the price sounds crazy, $10,000 per Bitcoin. It sounds really crazy, but the reality is it is only going to increase in price going forward. Well, that's it, guys, for this video. I've covered a lot in this video, and if you made it to the end, thank you very much for watching, and don't forget to subscribe and like this video to help me grow this channel. I would really love to get to 100 subscribers, and apparently the algorithms love it when you like and comment on videos, so please do so with this video. Thank you very much. Peace.